Hi, thanks for watching. Today I'm going to go with a quick overview of fixed income relative value trading, or FIRV. So first of all, what is this? It's a major way institutions hedge, speculate, or even just manage their balance sheet. One cool thing to point out is a lot of repo, what the secured overnight rate is, emerges from fixed income relative value trading because it's not just matching duration or hedging convexity. It can be a almost pure financial speculation. Right here, this is kind of overviewing it. A lot of what our overnight rate mechanics are emerges from short-term rates-based fixed income relative value trading. And I think just pointing that out shows the significance of this trade, because then you begin to realize the metrics that define pretty much the whole fixed income ecosystem comes from this type of trading. So basket delivery, this is what I consider, this is my main interest, and this is what I consider the purest fixed income relative value. And within the basket, for instance, it's not just a futures to cheapest to deliver trade, but there's a bond funding basis. If you create an equal carry index of the whole basket, and then you look at the cheapest to deliver, there's a basis trade between simply the basket itself and the cheapest to deliver. Then you go on to the cash to futures trades. There's hedge ratios. You're exposed to dollar funding rates. Even volatility distortions can mess up those calendars, mess up that cash to futures basis. And you're going to see there is so much to learn from fixed income relative value, especially in the Chicago Mercantile Exchange ecosystem. So this is kind of just a quick overview. So you can see number one here, there's basket financing differentials. For instance, what ratio of the basket are you holding? Even if it's total return swaps, or do you have a equal weighted index? Are you going with probabilities to cheapest to deliver? There's a lot of nuance there, and there's different carries on each bond, even if it's slightly different, and that can really change how a balance sheet manages things. You have CTD switching, so now the futures contract is going to move on a newer bond if the CTD switches, especially when you're further out from delivery. You see a lot of switching, especially in volatile rates regimes. There's special repo, which I'll even get onto this later in the presentation. Each bond can be financed differently, and that can completely change. You might change your holding within the basket just over liquidity dynamics with special repo. You have the futures to cash convexity mismatch. This is one of the hardest ones for me. I've tried modeling it, and especially when you break down into second order convexity, you're starting to see even small hair basis point moves. That ratio might blow out fast, even with the same cheapest to deliver, and you really need to watch that, especially if you're delivering on leverage. You have the dollar funding exposure. That's kind of, especially with calendar trades as well, that's going to move a lot on that. And finally, volatility price distortions. Just like SPXW options, just like selling iron condors, there is a massive exposure you have simply to human fear and volatility around it. So swaps, futures, ETFs, and options. For institutional efficiency, not all fixed income holdings are just pure bonds, pure treasuries, or even a futures contract. You have things like the iShares high yield and investment grade corporate ETFs. You have total return swaps, interest rate swaps, futures holdings, and you're starting to see the way that these are managed. For instance, how iShares manages its corporate ETFs, its government ETFs. There's a lot of fixed income relative value trading within there. And for the ETF traders themselves, and I'll get onto this with some trading strategies, even one ETF to the other could be a way to express your view on credit spreads, your views on duration. And when you start to get to credit default swaps, total return swaps, you're going to see that being paired with actual cash bonds. You're going to see that paired with futures. You'll even see some modern strategies, a total return swap or a default swap combined with puts on a corporate ETF. Like HYG, if you look at the puts options chain, I don't know which week you're watching this, but go to your phone, look at the options chain on the HYG ETF, you're going to see massive open interest, massive volume, and that's not just retail speculation. That is institutions combining default swaps with the probability analytics of the put chain on HYG. And some desks, even for delivery simulations, will use total return swaps of the cheapest to deliver and match that with its treasury future. And this allows the noise of coupon delivery to minimize it a bit, and you have almost like a simulated total return index, which is really helpful for basis traders. And I'm just showing the two parts right here. The baskets and managing ETFs, especially for corporate bonds, there's so much fixed income relative value in there. Before the process was as clean, you saw in the 2008 financial crisis, a lot of the less hedged, less proper math behind these corporate ETFs, a lot of them imploded. And to iShares' credit, their high yield ETFs survived the 2008 financial crisis, and I would argue solely due to proper fixed income relative value management. And now you can see in the second half of the image, there is a lot of total return swaps being written on the cheapest to deliver bond, just so a desk or a firm or any party with enough capital can simulate a basis delivery trade without having to deal with, oh, we've got a coupon in 5 days. How am I going to deal with this? How's this going to mess up my accrued interest? And how is that going to impact the invoice price? Now, special repo is a huge desk nuance, and this is where you'll see cold calling, face-to-facing mattering a lot. And as I mentioned in the first slide, much of fixed income relative value, if you have the convexity DV01 hedged properly and you account for volatility, turns into a basic financing differential trade. The nuance is bonds have special repo. For instance, a 5 coupon, a 3 coupon, and a 4 coupon in the same cheapest to deliver basket will have much different accrued interest dynamics. So using the same overnight rate on the dollar for all those bonds will create very inaccurate ways to view which one's the cheapest to deliver. Another point, though, is the special repo isn't necessarily a published public rate. When you start to look at places like Singapore, Hong Kong, there is a lot of qualitative face-to-facing on how is your special repo going to finance it. Do you trust a uncollateralized special repo on this bond with credit risk involved? And this is where you see senior economists, senior rate specialists working on the cash to futures basis trade. And how are we going to do special repo? Are we going to play it safer? Are we going to take some more risk? And should we even just have our own cheapest to deliver? That's one thing to consider if you're in high level rates trading. And this is just a general overview. Each bond has its own special repo. So if you're a basis trader, you're not looking just at SOFR, you're looking at what's offered. And one of the biggest dynamics is liquidity itself can change special repo. You could have a hypothetical ideal special repo on a bond, but a lot of it, an industry secret, just comes down to the bid-ask spread on the cash bond itself, how much demand there is for it, how much hedging there is for it, if it's on the run, and this makes a huge difference in how the bond gets traded. Convexity funding and hedge ratio pain. This is the point I want to make, that when you see the bond market itself, the buying of cash securities happening only at high level desks, a lot of people get frustrated and think this is excluding smaller firms, this is excluding retail traders, but there are structural reasons that it's this way. First of all, for most fixed income relative value, it requires access to the overnight markets. It also requires access to decentralized international markets like Hong Kong and Singapore. And as that other slide mentioned, you would need a team in Singapore, for instance, working with the overnight rate there, and also the hedge ratios, going away from financing and just back to DV01 and convexity. Those require massive teams. It's not a clean math. You can't map it perfectly. There's a lot of just the market will move and you have to follow it. And if you don't have a serious quant team managing that hedge ratio, it doesn't matter how well your financing is, the trade will blow up, and sometimes painfully so on leverage. And this slide's just pretty much showing why big desks can participate in. I should have added cash FIRV, but you're seeing pretty much it's a structural reason. It requires massive collateral, it requires large teams, and it requires, frankly, multiple risk management departments just to make sure things can work smoothly. And even with all of that, on any repo crisis, you're still going to hear about firms going under just because of how messy the situation can get. But there are retail proxies if you want to participate. So if you're watching this and you have Thinkorswim or Tasty Trade and you're thinking, I still want to participate in this game, there's some good ways you can. And the first and my favorite is UST futures calendars on the Mercantile Exchange. Now this one's awesome because institutions and retail can participate in this. And this really allows you to speculate on the richness and cheapness of the curve, or just how the curve itself is going to move. So fundamentally, you're entering the ideal trade of repo versus the yield on the cheapest to deliver. But where the nuance comes in as a trader, you can also look at the deviation with your proprietary modeling like I have on my GitHub. You can look at the deviation from the ideal and maybe trade, I believe the bond's too rich, I believe the bond's too cheap. And there's another way if you want to trade credit spreads, the HYG LQD trade, or investment grade to high grade spread. And simply put, it's just a buy one share, sell another. And also desks and professionals make this trade as well. Now this isn't the primary way a pro would trade, but you are seeing that you can, as a retail investor, you can trade calendars on futures of the treasury ecosystem. You can trade credit spreads. It's not going to be as clean, but you're not completely excluded. You still have a way with your balance sheet and portfolio to make expressions in this. And this is just a chart going over all of it, and it shows if you're creative and you have proper risk management, anyone pretty much with a brokerage and level 3 access, depending, I'm referring to Schwab here, can participate in the fixed income relative value market through proxies. Anyways, thanks for listening. I really enjoyed this topic because this is the heart of collateral, this is the heart of liquidity, and even the overnight rate to some extent is quoted on fixed income relative value trading. I hope y'all have a great rest of your day.